Welcome. Charles Sizemore here with lead portfolio manager and professor of finance at the IE Business School Madrid, Mario Randholm. Mario.
Hi, hello to everyone.
So to everybody joining, before we get started, I will ask one thing. You should be muted. Just please stay that way. I know sometimes Zoom has a mind of its own, so let's try not to let an open mic get disrupted here. So with all that said, let's get into it. We are living in an age of chaos, crisis, and conflict. This is not a political statement at all. It's just an objective statement of fact. Professionally, we're agnostic when it comes to politics. We're not particularly interested in pointing fingers. We're not particularly interested in assigning blame. What we're interested in is managing our portfolios, reducing risk, and getting through to the other side, no matter what the environment looks like. And so about that environment, what kind of environment are we in right now? Well, we got a reminder of that last week when Moody's downgraded the U.S. government's debt, knocking it off of its pristine AAA credit rating. Now, of course, this is not the first time we've seen this movie before. S&P did the same back in 2011, following a sovereign, sorry, not a sovereign debt deal, a debt ceiling crisis, and then we had a repeat in 2023 when Fitch did the same. So what's the deal? What's got the credit agencies all hot and bothered? What's the reason for this? Well, I'll give you 37 trillion reasons. This is, of course, our national debt, and it is getting rather out of control. We just hit 37 trillion, and in about 18 months, we should be crossing the 40 trillion mark. That's what you call a debt snowball, because we're adding to it at a rate of about 2 trillion a year. Now, getting this under control is going to be wildly difficult. Why? Let's imagine that Congress got sober today and decided that they were going to only spend $1 for every dollar they brought in taxes. Now, that's not happening. I think it would be a higher probability that the Los Angeles Lakers call my cell phone right now and invite me to join the starting five than Congress manages to balance the budget. So that it's not happening. But let's just say they did. Let's just suspend disbelief and say that Congress is only spending $1 for every dollar they bring in taxes. You're still going to see the debt load continue to snowball. Why? Because 16% of the budget is just going to paying the interest on debts already accumulated. What's worse, that debt is being rolled over at higher interest rates. Every bond that matures gets, you issue a new bond at a higher yield, making that interest expense even higher. So if you wanted to actually stop the debt snowball, not even pay down the debt, mind you, we're not even going there. Let's just say stop the snowball. You would have to run surpluses of, call it 20%, a 20% surplus. Well, good luck with that. I don't really see that happening anytime soon. So that's kind of old news though, right? I can't say it's old news, but this has been building for a while. What's changed? What's different this time? Well, the new administration is embracing a motto right out of Silicon Valley: move fast and break things. Now, this is great in the private sector. If we didn't have that risk-taking attitude, mankind would still be living in caves, right? You need risk-taking in the private sector. That is absolutely essential to growth and vitality. That's not generally how government works, though. This is a major departure from the past. Government is by its nature stodgy, boring, conservative, very resistant to change. Even small changes tend to be met with a lot of resistance, and they tend to be very disruptive. But what we're seeing today is not small incremental change. What we're seeing today is actually revolutionary change. Well, revolutions are messy. Revolutions are complicated. They very rarely go smoothly. That's why they're called revolutions. And we now have an administration that has fully embraced unpredictability as its brand. That makes it really difficult to model. So if you're in the financial world, if you're trying to model what is policy going to be, let alone how is that policy going to affect the economy, let alone how is that going to go flow through to profits, how is it going to flow through to the returns of the S&P 500, the bond yields, you name it. Good luck. There's so many moving parts right now in a world that's always complex is infinitely more complex today. Now, by the way, you might think these policies are great. You might think they're terrible. You might think some are great, others are terrible. It really doesn't matter from our perspective, managing portfolios, managing risk. What matters is that they're disruptive. They are upsetting the status quo and modeling what that will do, how that flows through to portfolios, how that could, cause domino effects. All of that is exceptionally hard to model. That's this age of chaos we're living in. Now, it's particularly true on tariffs, by the way. Now, there's been no single issue that has roiled the markets more than tariffs. And economic theory here is pretty straightforward. Higher tariffs do make all of us a little bit poorer. They do raise cost. Fine. I'm not really here to debate that, and that's not really even that relevant, because if you have a high tariff environment, eventually the market reacts to it. Life goes on, right? Markets adapt. The issue is you can't really adapt because it's still changing. If you're a large company, you don't know or even a small company, by the way, you don't really know what to do. Do you move your production to another country? Do you leave it where it is? Do you try to bring it to the US? That's not so easy. That's usually a multi-year, if not multi-decade process. You can't really make decisions that are going to affect your business over the next decade or more based on a sliding scale here, based on a tariff regime that is still in flux. So the result is massive uncertainty, very pronounced difficulty in making decisions, in actually investing, hiring people. Nobody knows what to do, so they're not really doing anything. That's the environment we're in. Another issue, and this is that whole kind of butterfly effect, chaos theory thing, is our financial system is always fragile. Like that's not new, by the way, but it's particularly fragile today because we have really high trade deficits. Why does that make our financial market fragile? Because when the US imports a lot more than it exports, we end up exporting dollars. We buy goods from overseas and then we give them dollars. Well, what do they do with those dollars? Those dollars cycle back into our capital markets, buying our stocks, buying our bonds. They keep stock prices high. They keep bond yields low. It's a steady stream of buying. Well, when you upset that fragile equilibrium, you see what can happen very quickly when you take away major buyers from that foreign money that's being recycled into the US capital markets. You don't exactly know where that will go, but you do see it in volatility. So, and by the way, I've focused mostly on government policy, but that's really just the tip of the iceberg. We're also in a period of massive, rapid technological change. What we're going through today with AI is very similar to the Industrial Revolution. Imagine you were a peasant farmer 300 years ago. Imagine how you watched the world change when suddenly machines were doing your job, plowing a field, when suddenly your entire way of life was upended and your job changed, your role in society changed. We're going through that today with AI. That introduces massive uncertainty that no one alive today has ever had to deal with. So volatility in government and volatility in the economy is flowing through to volatility in the market. We're seeing this. Look at the daily returns of the S&P 500 this year. You saw they got really wild and crazy there in April. It's not normal to have the S&P 500 drop by 11% in 2 days and then shoot up by 10% another. Like that's extraordinarily volatile. But what we've seen in history is that you get bursts of volatility like that. You go through long periods where the market's relatively calm, and then you have sudden explosions of volatility that can last for a while. They're not one and done. They generally last for days, weeks, months, in some cases, even years. So we're seeing this. We're seeing it now. I think we're still in really the early stages of it. It's not just stocks by the way. We're also seeing it in the bond market. Bond yields are the highest they've been in about 20 years. If you look at the longer end of the yield curve, 10, 20, 30-year bonds, 20-year highs there. You see gold at really all-time highs. It's just off of all-time highs that were set over the last month. People flock to gold when they're scared. It's a natural crisis hedge. Even cryptocurrencies. Remember, why does Bitcoin exist? Bitcoin was created back in 2008 as a reaction against the failure of the financial system and then the government bailouts to prop it up. Bitcoin was created to give an alternative to that system, and the surge in prices in Bitcoin and other cryptocurrencies today, that's reflecting that same sentiment that the system is risky, the system is under stress right now, looking for alternatives makes sense. Of course, one of the worst aspects of all is that all this is happening at a time when stocks are historically very expensive. This is the CAPE, the cyclically adjusted price earnings ratio. By this metric, stocks are the second most expensive they've been in history. The only time they've been more expensive was during the dot-com bubble, the late 90s. You can look at other metrics, price sales ratio, price earnings, whatever, pick one. They're all going to tell you a similar story. Stocks are historically very expensive, and they're expensive at a time when the entire world we're in is ripe for disruption. It's that proverbial bug in search of a windshield. So kind of summarizing the key points here, this environment we're in, stocks are expensive, bonds are, everything's expensive. This is an environment that is highly susceptible to major disruption, and that disruption is happening. And when it does happen, as we've seen, correlations of most passive asset classes essentially go to zero. Go to one. They all tend to move together. They all tend to crash together. So how do you mitigate that? Of course, one of our core, key strategies using niche active traded option strategies to mitigate risk, reduce portfolio volatility. So let's talk about this. This chart here is right out of one of Mario's MBA finance classes. So we're going to geek out a little bit here. Pardon the geeking, just roll with me. If you have asset A and you have asset B, you make a simple portfolio, your return is going to be the average of the two, right? So if asset A returns 5%, asset B returns 10, you have both in equal proportions, you're going to get a return of 7.5, right? Great. But your volatility, the risk in the portfolio is not a simple average of the two. In fact, the more uncorrelated the two are, the less your risk becomes. That's what's happening in this chart. You see that straight line gets bowed out into a curve. The less correlated two assets are, the more independently they move of each other, the deeper to the left that curve juts out. What does that mean? What are you looking at? It means that the less correlated two assets are, the more volatility reduction you get, the less risky your portfolio becomes. You want this to jut out to the left. It means you're taking less risk for a given level of return. So with that as your background, let me bring Mario back into the conversation. You've heard me talk enough. Mario, welcome.
Thank you, Charles. Hi, thank you. Thank you everyone for joining today. So let me tell you a little two key aspects of risk management, right? So the first of all is the correlation to the S&P 500. Most of us have already the S&P 500 on our portfolios, and it's going to stay like that. It's a great vehicle that has performed amazing during the last 100 years, right? We are not going to change that. But when building a portfolio, we have to take into account how much correlation we have to the S&P 500, and we want to avoid correlation to the S&P 500, right? The other key aspect of building a robust portfolio is how much correlation the individual components contribute to each other. So we also want very low correlation between the individual components of that portfolio, right? When we interview managers, we focus on that emphasis on risk management, right? We want people that live and breathe risk management to the portfolios because we know that long term that makes the difference, right? One of my filters is actually analyzing how these managers perform during the drawdown. Actually, I don't like to invest with people that never lost money, right? Because it's during those humble periods that the manager, the company, completes the entire cycle. They understand if they need to change the investment theme or stick to it. They understand what is the importance of keeping the clients, right? They understand how painful that process of learning through mistakes is. And in that key aspects, when they share their mistakes through the drawdowns with us, is we analyze if there's going to be repeatable or not, right? If we are going to allow this manager to manage our money or not. If we can leverage their mistake to try to avoid ours in the futures. So if we go to the next slide, Charles, this is our recipe, right? We have 11 strategies that have very little correlation to the S&P 500. The highest one is the strategy 7 that has 0.5% correlation to the S&P 500. The rest, you can see that move near zero. In some cases, negative. This is remarkable because every single of these strategies makes a premium collection in the market. They trade options in the stock market waiting to collect premium and then hedge out the risks with farther out of the money options, right? And why? How are we able to produce a concentrated portfolio of option managers, niche option managers that are focused on mitigating risks, have near zero correlation, right? And the trick is the duration of the trades. Some traders focus in very short-term trading, 1 or 2 days. Other managers focus in medium term, what we call 1 to 3 months. Even though the holding period might be shorter, they trade options that expire 1 to 3 months from now. And in the other side, we have managers that trade options that expire between 3 and 6 months from now. So the combination of these managers provides what we want: recurrent results, low volatility, and a product that we expect it will continue to perform through the next decade, right? And this works very much like an insurance company, and Charles will explain that later. I want to stress one strategy that we put there in red. It's called the tail risk strategy. Even though most of the strategies in the portfolios, they sell a premium, right? They expect to collect the time decay of options. This tail risk strategy does the opposites. It focuses on the time when there is a spike in volatility and try to profit from that spike. And that also convey a very important message to our portfolio, because from time to time, one of these managers might have a rough time, so it can compensate those periods. If you want, Charles, we can go to the next slide.
Yeah, sure. And kind of completing the insurance company analogy. So all of our managers have a basic core strategy, which is very analogous to an insurance company. The same way an insurance company just collects premium month in, month out, and that's just pure profit until occasionally a disaster strikes. And then, of course, the insurance company has to pay out. Fine. But the insurance company never goes broke because they always protect themselves with reinsurance. So that's exactly the same concept in the options market. You sell options that are slightly out of the money, expecting to collect that premium. Things go the wrong way, no problem. You've also bought options that are deeper out of the money that act as a backstop. That's the idea. It's very repeatable, just the way an insurance company model is very repeatable. So are these option strategies. Now, with the tail risk, we're taking the other side of that, though. We're not selling insurance, we're buying it, right? Except it's more like an insurance product that functions almost more like a lottery ticket, right? So when things go bad, we make an outsized profit. So looking at how that's performed, you see, normally, and a tail risk strategy is not going to give you much of a return. In most months, the return is effectively zero. Like you're lucky if it's zero. Sometimes it's even negative because there's a cost to buying the insurance. But it tends to pay off when you need it the most. For example, there was a massive surge of volatility in August of last year where the tail risk strategy did well. It made more than 10% that month. And then in the massive explosion of volatility that happened in April, this last month, the strategy did 25%. So that's, think of it as an insurance policy that pays off when you really need it. So great. What do you do with all of this? How do you actually invest? Now, you could, of course, use the niche option strategies as a standalone investment. It's great for that. The returns are competitive. The drawdowns are minor. It's a very suitable strategy to buy in its own right. However, where we see the real value is in adding it to a traditional portfolio. So most investors are going to have something that kind of looks like a 60-40 portfolio, right? 60% stocks, 40% bonds. Maybe the percentages are a little different, but that's the traditional portfolio that most people are going to have in their 401k, with their financial advisor, wherever. That's the industry standard. So carve out some space. Maybe chop 10% off of your stocks, chop 10% off of your bonds, and make room for something like that. What we find is you take a good portfolio, the 60-40 portfolio is good. It's a good model. It served investors well. But adding the niche option strategies into the mix makes it better. It reduces the volatility and it increases the return per unit of volatility. So that's where we really see the role there. We take an already good portfolio and we just make it better. So with that, I've taken up enough of your time. We'll wrap this up now. I will point out that we will not be having a Q&A session here just in respect for everyone's time, but we want to hear your questions. So please send us your questions, and we plan to follow up with each of you individually to answer those and anything else that might be on your mind. So thank you again for your time, and we look forward to following up with you.